Traders, have you ever had the perfect setup, but you still end up losing money? Well, odds are it wasn't your strategy, it was your risk management. In this video, I'm going to show you how to manage risk effectively when you're trading stocks and options. And stick around to the very end because I'll share with you my exact risk management strategy using a real life position. This will help not only protect your account, but maximize your profit while minimizing your losses. Before we jump into some risk management strategies you should consider and you should be using, let me first make sure we understand what risk management is, because I'll be honest with you, I don't think a lot of people really understand truly what risk management is. Managing your risk means managing your capital. And it means managing that capital like a business. When you think about managing your risk, think about how much capital you're willing to risk on each trade. And typically that number is calculated using a percentage or a set dollar figure. And the purpose of it is to keep you in the game. We want you to trade this game forever. We don't want you to trade for a day or 2 days or 2 weeks and then get blown out. We want you to trade forever. Risk management will help you do that. When I first started trading stocks and options, this was the most boring subject to me. I wanted to learn strategies. But now after trading for 20 years, I realized this is the most important concept you must learn. You can have a mediocre trading strategy, but if you manage your risk properly, you can actually turn it into a very profitable strategy. One of my personal rules is I want to have at most at risk 1 to 3% in any one position. That means if the entire position blows up, it goes all bad, I lose at most 1 to 3% of my account. Now I have a personal rule that allows me to go to 5%, but initially I'm at 1 to 3% of my overall account. Now please stick with me on this slide because this one is vital for you. Why is risk management essential to your long-term success? Look at these numbers. They don't lie. They're very honest when you stare at them in the face. Our goal with risk management is to allow you to stay in the game forever. This is what that looks like or doesn't look like. If you're risking 2% of your account in any one position, you can lose 50 trades in a row before you go out of business. The odds of you losing 50 trades in a row is pretty small. All right, let's increase your risk and notice what happens. If you risk 3% in any one position, then you could lose 33 trades in a row before you go out of business. Still not bad, right? The odds of any one of us losing 33 in a row are probably kind of slim. Now, if you risk 5% in any one position, you can lose 20 trades before you go out of business. Starting to be not quite as interesting, right? And that does depend on which strategy you're using. But overall, let's just stick with this concept. Percentages let you lose how many times? In my opinion, this next one is the real eye-opener. If you're risking 25% of your account in one position, you only get 4 losses before you go out of business. Now, 4 losses in a row, that's a very high possibility, especially in some of the volatile markets we've experienced recently. So a key point here, I just changed the color from black to red because I think it's very important. Notice that the higher percentage of your account that you risk, the shorter your survival window. When things go against you, you're a lot more likely to get put out of the business. And we don't want that. So let's give you some strategies that help you to stay in the business forever. Now that you understand the risk percentages, let's go over 4 advanced risk management techniques to take your trading to the next level. To help show you these 4 risk management techniques, let's use Tesla. I love the company and it's very volatile, so it's the perfect candidate. This isn't up to date. I'm going to take you back in time to a possible Tesla trade. So what do we see here? We see that Tesla, it's overall in a nice uptrend on this daily chart. It's making higher highs, it's making higher lows. All that looks good. And we see recently it's come back down and is retesting support right around this $370 area. It was an area that previously served as resistance and then it turned into support. So that's all looking good. So let's say right in here, we enter a bullish trade in Tesla. Now remember, we're thinking about risk management here. When is our bullish thesis wrong? Because this is the first way you can manage your risk. So when do we know that we're wrong in our thesis in Tesla? Well, I've drawn some support lines here for you. Let's first look at this diagonal support. So we have a really nice, clearly defined diagonal support right in here. The first sign that we might be wrong with our bullish thesis in Tesla is when it breaks that diagonal support, which notice it does right here at this yellow arrow. So if anything, that should be like a caution warning light saying, uh-oh, I might be wrong. I might have gotten the direction wrong. But when is a definite spot when you should know that you're definitely wrong in your bullish position in Tesla? Would you agree with me that when it broke this horizontal support as well, at that point, we're probably definitely wrong? It will have broken this diagonal support and now also this horizontal support. So did that happen? Well, let's fast forward in time and find out. So here we see Tesla going along and it is holding support, but then all of a sudden it drops below that support. So we've broken our diagonal support, we've broken the green 50 moving average on this daily chart, and now on this day we see this yellow arrow, we broke our horizontal support also. At this point, it's time to manage your risk, it's time to take the loss, it's time to get out. So one risk management strategy is to look at technical analysis and use that as a way to manage your risk. Unless you want to take assignment of Tesla, this is a good day to get out of this position. Why was it a good day? Well, notice what happened. Technical analysis would have saved our bacon in this position. Notice that line there around 370, that whereas it was serving as support before, it now became resistance. Tesla found resistance there several days, and then it just kept going lower. Technical analysis is one way to manage your risk. It's okay to be wrong. We're all going to be wrong in trading. What's not okay is to ignore the fact when you are wrong and stay in a position when you should be out. That's one of 4 strategies I use to manage my risk. Here's the second way I encourage you to consider using to manage your risk and to protect your capital. And this one is a dollar amount or percentage stop loss exit. Here you see an example of that in one of my smaller option trading accounts. I did a bullish put credit spread in the Russell. If I move myself up here so you can see the important data, notice what I told my patrons. The exit stop loss trigger on this position is that the position is down 25 cents per share. Another way to manage your risk is to exit when a position is down a certain dollar amount or a certain percentage. With this trade, it's a very simple stop loss exit. If the position is showing a loss as much as the credit we received, then we're out. I'm telling you from personal experience, honoring this stop loss will save your account. There's been times, even sometimes recently, where I've ignored it and it cost me. So if you set an exit stop loss trigger based on a dollar amount or percentage, you honor that loss. Get out if it says you should get out. Now, one thing I do like to do, which I'm okay with, especially for experienced traders, is to combine technique number 1, using technical analysis, with technique number 2, using a stop loss trigger. For example, I allow myself the ability to stay in a position if I'm down the 1x amount or down the amount of credit I received, but the technicals look like they might hold. Just understand that you're breaking one stop loss rule. So you have to be disciplined so you get out if it breaks both of those rules. I'm okay with doing that because I'm a very experienced trader, but I never risk more than I'm willing to lose. I don't think you should give yourself that leeway if you're risking more than you really should be risking. You have to get out when it says to get out. Let's move on to technique number 3. This third technique is really cool because you're actually using the entire stock market, using almost every trader in the world to help you win. Here's how you set that up. Whenever you're placing a trade, make sure you place it in a spot where you'll have at least 1 or preferably 2 support levels to help you. How does that help you? Here you see 2 potential support levels for Tesla. Let's discuss this top line first. Notice this is an area that served as support for it right in here, and then served as resistance for April, May, June, and part of July. Eventually, it broke out from that resistance, and notice what happened. It rolled over, came right back down to that area. Remember, once resistance is broken, it tends to turn to support. In other words, once it gets back down to this area, you typically have more buyers than sellers. This is what's known as a demand zone. People want to buy or they demand the stock at that point. So let's say you want to take a bullish position in Tesla. Is this a good time? Well, the daily chart doesn't look great. You've just recently made a new lower high and lower low. So that doesn't look great, but you are coming into some potential support. And what's even better than 1 support? Well, how about 2 supports? Because right in here we have this area that previously served as support for Tesla. So we know that people really like buying Tesla back in this area, which is around $169 per share. So we have 2 support levels. Is this potentially a good spot to take a neutral or bullish position in Tesla using stock or options? Well, in my opinion, possibly. If the hourly chart looked really good at this point, then I'd say yes. But in the back of my mind, I'm remembering that we're in a bearish trend on this daily chart. But we do have 2 support levels. Now, going back to our previous analysis, remember technique number 1, if it breaks support, then we're out. Well, that's the rule you could use for this. We're back at a very strong support level. In fact, we have 2 support levels. So if we're okay with dealing with the stock coming down and testing both these support levels, it might be a good time to buy the stock or to sell options in Tesla. And the reason? Because you have a lot of buyers around the world in the market that will probably come in and help save your trade. But just remember, if they don't step in and it breaks through these support levels, you need to get out of there. Fortunately, if you took a position that was neutral or bullish in Tesla at this spot, notice what happened. Buyers did come in and the stock took off. But the reason this would have saved you if it went against you, because remember, we're not talking about wins here. We're talking about protecting your account. The reason why I like this setup, even though it's bearish on the daily chart, is there potential buyers here. And if those failed, that would tell us we need to get out because those buyers were no longer interested. Using multiple support levels is a great way to use the market to give your position a chance to win, to improve the odds of you winning on your trades. And of course, if you're bearish, the opposite would be true. A strong support level, or even better, 2 strong support levels, allow the market to be your partner, allow you to improve the odds you're going to win. Let's move on to risk management technique number 4. And I really like this one. This one to me is like the hard stop. This is one that when all else fails, this one comes to the rescue. Here's a post I share my patrons every weekend. It's a post where I share my top picks for the week. These are companies that technically look like they have a good setup, but even more importantly, when it comes to my fourth technique here, I share a list of companies that I believe are undervalued. If a company is selling for less than it should, doesn't that kind of give you a way to manage some risk? If it's selling too cheap, you would think eventually the market will figure that out and save you. Well, let's look at a trade where I use all the techniques I shared in this video to help bring this all together. And as I scroll down here you see the ticker symbol that I believe at this point was fairly or undervalued that I took a trade in. It was NVS. Let me show you how I use all these techniques to help form a winning trade that would give me some protection if it didn't work out the way I expected it to. I know there's a lot going on with this chart, so let me kind of talk you through what my thinking was when I entered this trade. So here we have NVS. Notice that overall it's been in a downtrend. So obviously that's not a great time to sell a cash or put option, most likely. But notice what happened. You see this diagonal resistance line here? It broke that downtrend. It found support multiple times in this area right here around 96. Buyers and sellers kind of struggled back and forth, trying to determine, was the down move over? Was it still going to keep going? Well, eventually we see it broke that diagonal resistance line. Now I had to test the horizontal resistance because this area right in here around 100, well, now I had to break through that horizontal resistance around 100. So it took several days, but eventually it broke through that area. Then it broke above the green 50 moving average. At this point, I began to like the stock. Another reason why I liked it was that fourth risk management technique I share with you. I believe at this point it was fundamentally undervalued. On the day I did this trade, it was trading for about a 13 P to E. Normally over the life of NVS, it trades at a 15.6 P to E. So if we do some quick math here, we see that it wasn't greatly undervalued. It was only undervalued by about 17% based on its history, but overall it wasn't overvalued. It was fairly or maybe slightly undervalued. That helped me manage some risk. So we have fundamental analysis on our side. We have a support zone where I believe buyers would come in and buy the stock because it was resistance. If it came back down, buyers would come in and buy it. So I have a lot of the stock market on my side now. I also broke through technical analysis diagonally and horizontally. But keep in mind, if you didn't want assignment, then you would need to have a dollar stop loss, maybe the amount of credit that you received up front, which I'll show you in just a minute. Now, technical stop out could be if it broke through this line here at 100. Say, for example, it came down and retested this $100 area and pushed through there. Well, that might be your trigger to get out. And I would say definitely if it pushed this other support area right here around 97, well, at that point, from a technical standpoint, we're wrong. Our bullish thesis is wrong. It's time to get out of this position. Now, I showed you the daily chart. What about the hourly chart? So I like to have as many time frames lined up in my favor as possible. So now we're looking at the hourly chart of NVS. And notice what had happened. Again, we see it broke out above that $100 area and it was in a nice bullish uptrend. So if you're going to set a technical stop out, you really can set it at any one of these support levels. For example, we had support right in here around $103. We also had support right in here around $102. We had additional support right in here around $101. It doesn't matter how picky you with your support. But notice I had multiple time frames lined up in my favor. Now for our fourth technique to manage risk that I did with this trade. Remember, I still like to risk at most 2 to 3% initially, and at ultimate most, if I'm repairing a position, 5% in any one position. That way, if the stock went to zero, I could lose 20 in a row. Well, let me show you what I do when it comes to risk management and the amount of capital I had at risk. Here you see I sold to open the NVS March 21st $100 cash put options, and I got $1.57 per share. This amount was only 1% of my overall portfolio. If the stock went to zero, I would lose 1%. Now the next day, I did add one more position, so I was at 2%, but still well below my initial position size maximum of 3%. So how did this trade turn out? Well, because we had technical analysis on our side, we had buyers ready to buy and support us. Our risk management was in place and we were protected. We exited this trade several weeks later for almost 100% profit. Now I want to show you the power of what we just did. Remember I said we put the stock market on our side? We allowed buyers to be on our side. We allowed buyers to help us win this trade. Well, here we see the hourly chart of NVS. I want you to pay attention to what happened with the stock as compared to the S&P 500. So this yellow arrow over here on the far left is when we entered, and the yellow arrow over here on the far right is when we exited. So notice that NVS was up about 7 to 7.5% during this time. Well, what about the overall stock market? You see that during that same time frame, the overall stock market was down by 5%. The S&P 500 experienced a pretty sharp decline during that time frame. We had buyers lined up on our side of NVS, but the stock market did not have buyers lined up. That helped us win on this trade. So let's bring this full circle. Let's give you a checklist you can use starting today to protect your account. Here are the 4 ways I like to manage risk. Number 1, risk at most 1 to 3% in any one position. And keep in mind that if you have 20 positions on, they're all risking 5%, and the market goes against all of them, well, that can be counted as one position. So be prepared to deal with a position when they go against you, or positions if you're doing more than one at a time. Number 2, use a technical or dollar stop loss exit trigger. Have a technical spot that will tell you you're wrong if it gets there, and set an alert so you get a message whether you're on your computer or not that's time to get out of that trade. Or have a dollar stop loss trigger like I showed you I had on my IWM position. Number 3, put the stock market on your side. Line yourself up so the majority of traders are going to help you win that trade. In other words, if you're buying stock or selling put options, do that at support levels. And even better, do your position will not be challenged unless they have to break through 2 support levels. That means you have 2 groups of buyers who will jump in to try and help you win that trade. And finally, number 4, if you're going to take bullish or neutral positions, only do that in fairly or even better undervalued stocks. So I'm going to offer a challenge to you. I hope you accept this because this is very important for you. Try applying at least one of these risk management strategies to your next trade, and then let me know how it turns out. If you'd like to get an alert whenever I buy stock or sell options, check out the benefits of becoming a patron down at the link in the description below. Using technical analysis properly is a tool that helps you to win more trades and protect your account. To see what my favorite technical analysis tools are, check out the video at the link above and the description below entitled, "What are the best technical analysis tools for option trading?" Until next time, happy investing, and we'll see you again soon.